Hey, good evening. I'm Debbie Lucas, the director of the Golub Center for Finance and Policy. I want to welcome you all to our third annual conference. This is an amazing collection of people. We're really honored that you're all here to discuss this very important topic. I don't want to take too much time, but I want to introduce someone who I know is familiar to many of you. It's our keynote speaker, Jeremy Stein. Jeremy is the software professor of economics at Harvard University. He was a member of the Board of Governors of the Federal Reserve System, where he was an eloquent and influential voice for incorporating financial stabilization considerations into monetary policy. It's also great to welcome Jeremy back to MIT, his PhD alma mater, and home for 10 years as a member of the finance faculty at the Sloan School. I don't want to take any more time except to say that Jeremy has an amazing ability to creatively identify and address financial policy challenges, and I think you'll find the topic of tonight's talk no exception. So please join me in welcoming Dr. Jeremy Stein.
Okay, we good? All right. Thanks, Debbie. Thank you very much. And thanks for having me. It's a pleasure to be here. So what I thought I would try to do is talk about some recent work that I've been doing with Robin Greenwood and Sam Hansen, two of my colleagues who are at HBS, about our view. And I think it's a pretty personal and somewhat idiosyncratic view of what the Fed's balance sheet might look like going forward. And in particular, we're thinking about this very much, as Debbie suggested, from a financial stability perspective. That is to say, in the service of financial stability, what might the Fed's balance sheet might want to look like? So just to make it a little bit concrete, many of you know, but the Fed's balance sheet these days is about $4.5 trillion, up from about $800 billion in the period before the crisis. On the asset side, really simply, there's about $2.5 trillion of Treasury bonds, with an average maturity of maybe 8.6 years, something like that, 1.8 billion of mortgage-backed securities, and then just a little bit of other junk. On the liability side, about 1.4 trillion of currency, 2.6 trillion of reserves. Just to be clear, reserves are deposits that banks make that now earn 50 basis points of interest that banks make at the Fed, and then a little bit of other stuff. And here the little bit of other stuff is a little more interesting to us. It's reverse repo, which is the Fed effectively, like any other big hedge fund, financing itself by borrowing against it's using its Treasury securities as collateral. Okay, so that's the Fed's balance sheet. And the question we want to ask is, let's imagine a world, and maybe it's in a galaxy far, far away, where interest rates have finally lifted off. Okay, and imagine we're at 1 or 2 or whatever %. And so, the original motive for the large balance sheet was to provide additional accommodation when you're stuck at the zero lower bound by basically buying long-term treasuries and pushing down on term premium. Suppose that motive is gone because you have the regular interest rate tool back. What should you do? And I think the sort of default presumption, and the Fed's articulated this as the default presumption, is, well, since we don't need it for QE purposes, we should essentially try to shrink back to something like what we used to be. So given the growth in currency, that would be like a balance sheet of, say, $1.5 trillion, mostly currency, a little bit of reserves, much smaller. Okay? And our basic argument is this, that we think that there's sort of a good reason to think about leaving the balance sheet large, but no longer because you're preoccupied with the asset side of the balance sheet and monetary accommodation, but rather you should think a little bit about the utility of the liability side and the fact that the Fed has become, over the last several years, a very important provider of safe short-term claims to the financial system. Okay? And that's important. And the essence of our argument is basically, it's a crowding out argument. Okay? So to take a step back, here's a real thumbnail sketch of the financial crisis. A bunch of private sector guys got way in over their heads, borrowing too much on a short-term basis. There was way too much short-term funding. Okay? That leads to runs, it leads to all kinds of bad stuff. That's the lesson we learned. Okay? What do? We somehow don't want, and there's externalities basically. Every individual player is borrowing short term, not fully internalizing the damage that this can do to the system. the standard conclusion has been, well, that's bad, and we should pass some laws basically that they shouldn't be allowed to do it. Okay, so we have a bunch of stuff that can be basically interpreted as telling the banks, all this short-term funding, banks and dealer firms, all this short-term funding, not good. Okay, so now there's the liquidity coverage ratio, where they have to hold a lot of Treasury securities against their short-term liabilities. There's the net stable funding ratio, which basically says not so much of your borrowing can be short-term. There's higher capital. All of that is, in some sense, a regulatory effort to lean against so much short-term borrowing. And that's surely, broadly speaking, in the right direction. I mean, the issue that arises is, banks have, regulatory arbitrage has been known to be a bit of a problem, and you can make all these rules, and then you got to wonder, to what extent are guys going to play by the rules, either because stuff will migrate or will take new forms or what have you. I feel like the question you need to ask, sort of, at a high level is, before you pass all these rules to say don't do it, ask yourself, why were they doing so much of it? Okay? There's a pretty simple answer, because it pays, like really, really well. So here's a simple fact. If you look at the average slope of the yield curve at the very front end, so take the period 1983 to 2009, on average, the 1-week bill yielded approximately 60 or 70 basis points less than the 6-month bill. That is to say, the yield curve was very steep at the front end. Okay? That's a lot. I mean, maybe 60 basis points doesn't sound like a lot to you. That's a lot of slope for relatively little interest rate risk differential. So that's a great trade. And if it's there, guys are going to take it. And so if you ask yourself, why was Lehman Brothers using so much overnight debt? Kind of that was their business model, and it was because it was very lucrative. So, point is, given that kind of thing, you can try to regulate and just say, don't do it, but there's going to be an overwhelming economic incentive to do it. And that you could get a little complacent right now because the yield curve doesn't have that normal shape. So there's a little bit less of this going on. But the worry would be when rates start to go up and the yield curve kind of resumes its normal shape, that incentive will reassert itself. And even though you have a bunch of rules in place, things are going to start leaking out around the edges. So our whole kind of mindset is, as a complement to regulation, is there anything you can do to dampen that incentive? Is there anything you can do to make it not be 60 or 70 basis points? And here's where the crowding out idea comes in, which is that basically, the market, the world seems to value very, very safe short-term stuff. So think about, money market funds. They've got to find things to invest in. They like, short duration things. In fact, regulation kind of, increases that to some extent because they're regulated on their weighted average maturity. But anyway, things that are really short-term and safe are attractive. Okay? The Treasury has simply not made that many T-bills. So what's the private sector going to do in the face of this sort of demonstrated appetite for this stuff? The private sector is going to say, well, I can make something that's kind of like T-bills. It's repo, it's asset-backed commercial paper. It's the private sector's efforts to make. So I'm thinking of this stuff as essentially money-like. It has a low yield, just like currency has a low yield, because it provides a service. It's a sort of money-like service. And if the government doesn't provide enough money, then the private sector will. Okay? So, and then the sort of corollary of that would be, if the government would provide more, it would presumably affect the shape of the curve, affect the incentive, and then the private sector would find it economic to do less. That's not meant to be a substitute for regulation, but maybe it's a complement, and the regulation has a chance to work a little bit better if you're not asking it to fight against 60 or 70 basis points of incentive. Okay? So that's our basic idea, that that it would be a good thing and sort of complementary to regulation to have the government be a sort of ample supplier of safe short-term claims. That's our basic idea. Now, we've been sort of on this thing for several years, and when we first started on it, we really conceived of it not so much as being about the Fed, but being a theory of the structure, the maturity structure of Treasury securities. That the Treasury should basically issue more at the very, very short end and satisfy this thing. And by the way, there's evidence of this mechanism at work, which is if you look at time variation in the supply of Treasury bills. Okay, so T-bills go up and down. When there are more T-bills in the system, this yield differential tends to narrow. And interestingly, private sector issuance tends to go down. Okay? Now, there's the usual correlational kind of problems, but you can actually kind of get a causality a little bit because some of the variation in Treasury issuance is pretty mechanical. It's like around the tax calendar. So right before April 15th, there tend to be a lot of T-bills. Then people pay their taxes, and so the Treasury is borrowing less, and there are less T-bills. And if you look around that kind of variation, you will see, again, when there are more Treasury bills outstanding, this yield spread is less, and there's less private sector issuance of commercial paper, large time deposits, things like that. Okay? So that sort of suggests that there's the potential to do this crowd out. We sort of tried to make this argument to Treasury, not that much take-up, really. Okay? And the thing that you kind of get as a response is, geez, you want us to issue, I mean, I'm going to sort of, exaggerate it a little bit, but, you want us to issue $1 or $2 trillion of one-week bills? Do you know what we'd be having to do at auction every week? And like, what if one of these auctions goes wrong? So they'll talk, if you talk to Treasury debt managers, they're very, very focused on auction risk, refunding risk. Now, there's sort of two ways to think about that. One is just the concern that if you fund the government short and rates go up, the government's interest bill will go up. Now, there's nothing the Fed can do about that, right? Because if you consolidate the Fed and the Treasury, if on a consolidated basis the government is borrowing short, you're going to have more of that. A different notion of risk, which is, I think, more specific to Treasury, is the idea of something going wrong at an auction failing. What does a failed auction mean? It means they're trying to sell, X number of bills, and somehow not enough people show up, and they don't have the cash as a result to pay off the departing investors. Okay, that's the sort of strong version of it. But it's the idea that the auction may not raise enough money, if you will. Now, that's a place where the Fed can help out, because, of course, the Fed creates the final means of payment. There is no analog to a Fed having a failed auction. So if you think about, now that the Fed pays interest on reserves, interest-bearing reserves are kind of like, the rate can kind of adjust. They're kind of like perpetual floaters, right? There's no issue of the Fed having to roll over its reserves because if somebody says, I want my money back, it's okay, here, I'm paying you with reserves because that's the final means of payment. So the Fed has an advantage, basically, that it can't, there's no analog to it running out of money and having a failed auction. Okay? So that suggests, well, maybe the Fed should sort of be in the business of being at the very, very short end because it can essentially get around these rollover problems. So just, again, as a sort of numerical thing, the Treasury right now has approximately $380 billion of T-bills outstanding with maturity less than 30 days. That's not a lot. Okay? The Fed ramped up from 0 to a couple trillion, as we saw, pretty quickly. Nobody worried about sort of their rollover stuff. And even when the Fed finances not with reserves, but with this reverse repo, it's not a big deal. If they do less repo one day, they just fill in the gap with reserves. So again, they don't have this kind of funding. So in some sense, we think the Fed has a comparative advantage at supplying this very short-term stuff. In an ideal world, something that the Treasury could do it as well, but institutionally it seems like the Fed may have an edge. Now, balanced against that is, I think there's a sort of broad view that the Fed should just have a smaller balance sheet. That in some sense, and I think there's an absolutely respectable, I don't mean to be at all sarcastic about it, there's an absolutely respectable view, which is, look, if you do this, the Fed is in some sense, if you stay with a large balance sheet just for this purpose, the Fed is taking over a part of what is traditionally Treasury's job, which is debt management. Okay? And thereby, they're in part setting the fiscal risk profile. Right? In other words, then on a consolidated basis, they are helping to shorten the average maturity of the consolidated government debt, and they're contributing to sort of interest rate risk that the government, and that's not the Fed's job. That in some sense, that should be done by our elected officials in the Treasury, and Fed independence is best preserved when the Fed doesn't have too large a footprint in fiscal affairs. Okay, so I think a lot of people who want to see a smaller balance sheet, basically, and you can think of this in terms of remittances going up and down, but it's basically the Fed should have a small fiscal footprint. And to be clear, I agree with this. We agree with this, and we think it's sort of an objective that should be respected. The only point I want to make is there's two ways to shrink the Fed's fiscal footprint, to shrink, in some sense, its contribution to the consolidated interest risk of the government. One is you take a $4.5 trillion balance sheet and you just proportionally shrink it. That is, you keep the assets kind of roughly what they are, but you just shrink the thing by a factor of 3. Okay? Another thing that you could do, and which we would sort of say is preferable, is you try to keep the size more like what it is, but you take the assets and you try to reduce the duration of the assets. So right now, if you look at the distribution of Treasury securities, those that are owned by the Fed are mostly at the long end. Okay, the average maturity is like 5 years. The Fed is very concentrated at the long end. If you just brought them down to owning the same amount of securities but kind of in a pro rata way, you'd bring the duration down to 5 years. You could pretty easily, given what's out there in the market, we did some sort of calculations, you can pretty easily bring it down to 2.5 or 3 years. Okay? And it turns out that a $4.5 trillion balance sheet with maturity of 2.5 years has about the same fiscal risk, it's not rocket science, as a $1.5 trillion balance sheet with 8 or 9 years of duration. So our thing is, if you want to shrink the fiscal footprint, absolutely good thing to do, but I would at least start by, once you're no longer in a world where you need to do QE at the long end, there's no reason to be way overweight 9, 10-year bonds. You can basically bring it in. You can considerably shrink essentially the interest rate risk that the Fed is contributing to, and then at the same time, you can keep kind of all these short-term claims out there. So I think that's our kind of, one piece of our thing. Then the other thing, and this gets a little bit more techie, is what would you like the liability side of the Fed's balance sheet to look like? So again, all the focus has been on the asset side, and should we be buying mortgages? Should we buy long-term? Not so much attention on the liability side. Basically, they financed almost all of this expansion, as I said, with reserves. That is to say, by borrowing from the banks at a rate which is now 50 basis points. Okay? A little bit of borrowing in the market, if you will, borrowing from money market funds with this repo program. Okay? Now, interestingly, the rates on those two are about 25 basis points apart. That is to say, the banks are being paid 50 and the money funds are being paid 25. Now, one thing you need to know, reserves, only banks can earn interest on reserves. So this is it's like a special kind of T-bill that only special people get to have. Okay? So why in the world, from the perspective of our way of thinking about it, why in the world would you ever want to do that? I mean, it's sort of the tradition is that the Fed finances itself with reserves. But think what happens if you say, well, I'm not going to do so much of that. I'm going to raise, so there's 50 basis points as the reserves, 25 basis points is this repo rate. Suppose you start raising the repo rate. You raise it to 25, 30, 35. What's going to start happening? More and more people are going to find that attractive. You will be financing yourself more with the cheaper stuff and less with the more expensive stuff. So first thing you'll do, by the way, just incidentally, is you'll save taxpayers a couple $1 billion a year. Okay? But I think this is where Milton Friedman would have said, sort of in the spirit of the Friedman rule, doesn't it have sort of normatively good properties if you basically think a little commercially here and say, I should fund myself as the Fed as cheap as possible? In some sense, I'd be allocating my liabilities to those who value it the most. That's very much what we would like from the perspective of our crowding out thing. In other words, there are money funds who basically are hungry for assets, right? If they can't get enough, they're going to basically go out and buy asset-backed commercial paper or repo or whatever. Okay? All those reserves in the banking system aren't doing them any good. They're basically not allowed to tap into them. It's a weird thing. So you've got this sort of non-competitive market over here that's creating a lot of rents for the banks. So it's good for the banks. It's expensive for taxpayers. But especially from our crowding out perspective, it's just not acting as a available substitute for the money funds. So our second kind of leg of our thing would be basically let the repo rate rise. In some sense, I think a much more natural benchmark is these rates should be pretty close to one another and let the market decide effectively what's the right way to allocate. And our thought is then, what would be likely to happen is reserves would shrink by $1.5 trillion, or, I'm just making it up, and repo would go up, and then you'd basically create a lot more in the way of investable assets, and again, you'd be doing a better job on the crowding out dimension. So, our broad, if we had a sort of set of recommendations, it would be don't be skittish about keeping the balance sheet large. Do respect the fiscal footprint thing, but try to address that at least to first order by working on the duration of the assets. And third, the Fed has basically said they don't like this repo program, that in fact they're just using it to try and put a floor under interest rates. As soon as they've got that covered, they're going to phase it out. We think that's sort of exactly upside down, that this is actually a very good thing that they've got. And then the final word is to think a little bit about what happens to all of this, to the urgency of all of this as rates start to go up. Again, I think there's a little bit of a danger that you can get complacent now in a low interest rate environment because things have just been basically kind of calm. Okay, I mean, I shouldn't say, there have been a lot of stuff going on in terms of reach for yield and so forth on the asset side, but if you look at the liability side, if you ask yourself, do we have a lot of problems with excess short-term funding, that side has been a little bit calmer. But one thing to think about is as rates rise, think about how the financing side, how the funding side of financial institutions is likely to adapt. So there's a lot of empirical evidence that basically what happens as rates go up. Right now, probably all of you have checking accounts with way too much in your checking account. You're getting zero interest, but you're probably not paying too much attention because if you moved it to a money market fund, you'd get zero interest there, right? Right? So what's going to happen when rates go to 2 or 3%? The banks are going to keep the deposit rate at zero because they're price discriminating. They've got a few people who are just asleep permanently. But those of you in this room who are financially shrewd will take some money out of your checking account and you'll move it into money. So there'll be big outflow. I mean, this is an empirical statement. There are large outflows from sort of stable deposits. They go to the money funds. Okay? Now, the banks, especially if they've got all these reserves, are going to have to bring the funding back. But it gets brought back now via the money funds. And so now it's not stable transactions deposits. Now it's hot money. Now it comes in as wholesale financing of one sort or another. So as interest rates go up, this sort of profile of the funding side becomes much runnier and much more sort of vulnerable. So then this is when these sorts of concerns become a little bit more important. So I think this is exactly the time, instead of the Fed pulling back, when they want to be trying to make stuff available. And if they don't, then that's when you worry that basically we're going to rediscover a bunch of the stuff that we saw last time around. Okay, so that's our basic pitch. Do I have time to take a few? Yeah. Okay. Yeah, please. Or do we want to wait for you to get a mic?
How would you adjust what you said for the change in see now huge money market funds being converted to floating rate? So suddenly, the biggest part of that market is no longer
Yes.
cash equivalent, and what we've seen is that there's been a huge exit from that. So the demand for those types of assets, may be much lower.
Right. So it's a good question. So and again, I think this gets back to the sort of question of where rates are. So right now, everybody here. So basically, because of the SEC regulations and the floating net asset value, a lot of money is leaving prime money funds, and maybe that will be sort of how it stays. What I wonder is when rates go up, and again, money starts wanting to leave the banking sector and it's looking for a home, whether either it will be ultra short duration bond funds or something that basically wants to fill in this role. I think it's a little hard, both because it's early days and because rates are low and so the pressure is not as high. It's a little hard. Again, I wouldn't be too complacent and say, oh, we're going to be okay. This sort of class of money funds is going to go away, and so we're not going to have this sort of demand for the short-term paper from the banks. I suspect that something, I don't know what form it will be, but there will be at least a pull towards something that might try to take its place.
Quick question. I thought your comments on the fiscal stimulus were very, very interesting.
Yeah.
I'm sorry, the fiscal footprint, very, very interesting. There's probably been hundreds of thousands of pages of Wall Street research written about how the Fed views asset sales. Mm-hmm. And in particular, is the Fed willing to sell assets when rates have gone up dramatically? I mean, how is it, if you sell assets, if you sell treasuries at a price of 85 or 80, is that a bad thing? Is that a good thing? And in your remarks, you seem to basically, I think, sort of say, well, the duration is important, but that seemed to imply an indifference to selling assets at perhaps a low value.
Yeah.
at a market price, which is then lower than the purchase price. And I'd be interested in views on how that comes into play.
Yeah, I'm sort of.
Sorry for the poorly worded.
I'm sort of neutral. In other words, I think even so, first of all, we're sort of sympathetic to a larger balance sheet, all else equal. So right away, there's less urgency to sell assets. Even a lot of the folks who want the balance sheet to be small, I think have in mind to a first approximation they'll get there just by stuff rolling off. So we thought about this quite a bit with respect to mortgage-backed securities in particular. The idea of selling a lot into an illiquid market doesn't make a whole lot of sense. So I don't think, certainly we're not advocating, and I don't know that there's a very strong constituency anywhere for sort of active selling of stuff. I think we would, in our vision of it, we would let stuff roll off, and as it rolls off, rather than just letting the balance sheet shrink, we might replace it with shorter maturity stuff. That's sort of how we would get there, I guess.
If you're letting the market decide the size of the Fed repo market, are you setting things up for a huge flight to quality
Yes.
if they're financial stability questions?
Great question. So yeah, so this I left this out. So one of the concerns, this is probably among the folks who are uncomfortable with this thing, in particular with the aspect of doing more RRP. This is one of the biggest concerns. So let me just try to make it clear. Suppose that what you do is you set the, again, just to make an example, you set the interest rate on reserves at 50, and you bring up the other one, let's say, to 40. Okay? And let's say in that world, and it's uncapped, so people can get as much as they want at 40. And let's say that as time has passed, at 40, repo has grown to $1 trillion. Okay? But now we have sort of a shock. Okay? So there's a stressful situation, and all of a sudden the money funds are like, I want something safe. I want out of commercial paper, and I want into something safe. Now, what normally happens in a flight to quality episode like that is there's a fixed supply of T-bills. Okay? So they bid for the T-bills, the yield on the T-bills goes to 0, and things equilibrate. In other words, you get a large spread between commercial paper and T-bills, but that's mostly accomplished by the T-bill rate going down, so commercial paper doesn't have to spike. Okay? The concern that people have raised is, well, but if instead you peg the rate at 40 basis points and say, we'll make quantity elastically available, then the T-bill rate doesn't go down, and all that happens is the quantity goes up, and for the thing to equilibrate now, the commercial paper rate has to spike up. And that's a sort of stress on the system, and things. So that's a totally legitimate concern. I think it's one that can be addressed, and what you do is essentially you want to cap. Let me take a step back. The RRP program has already been designed, it's been on and off, but they have capped it on occasion. So they're very well set up to cap it because every day guys submit price quantity demand schedules, and if at a given rate you get too much, they just cap it and then the yield falls. So I would have a cap in there. The only difference is rather than capping it at some arbitrary initial value, like 300 billion, I would say in normal times, let it find its level. We set it to, say, 40 basis points, let it find its level, maybe it's $1 trillion. But then you have essentially a dynamic cap, which says at no point in time t can the quantity be any bigger than 110% of the last 6 months moving average. I mean, just to give you an illustration, but you do want to be careful that in a stressed thing, you don't elastically provide. So it wants to be globally able to adjust, but not locally able to spike up the quantity. Otherwise, I do think that you have to worry about that concern.
Hi, Jeremy. Brilliant as usual. Michael Barr, you can't see in the haze. So you described the current approach as basically a prohibition on private money, but I think it would have been more natural to describe the current environment as a tax. So you can think of three approaches. You've got a tax approach. You've got an ex-ante punishment approach, which you can think of as like getting rid of the QFC exemption or something like that, which is nuts, but it is out there. Yes. And then you've got insure everything, which is sort of you. And those are the three approaches, right? You can basically substitute public money, you can tax private money, or you can blow the whole thing up in the middle. So I kind of get why you like the more public money, less private money, but you could get that by making private money more expensive by taxing it, or getting the other stuff cheaper, which is what you want to do. So you can say more about why the taxing it approach is going to be worse.
So yes, absolutely. So that's a great question. So you can think of regulation as sort of the limit case of a particular tax regime. It was a particular kind of nonlinear tax regime. But if you have a slightly more general thing where basically what you're doing is imposing a sort of Pigouvian tax, if you will, on this stuff, our assumption in either case is that it's either the regulatory system or the tax system is imperfect. In other words, if you can identify everybody in the economy who does this activity and you can impose the tax on them in a non-frictional way, that is the first best. Okay? So if you work this out in a model, you will only want to use our kind of crowding out thing to the extent, and you'll want to do it more so if regulation is imperfect. So in a relatively bank-dominated economy where you kind of have the perimeter, then you would more want to use regulation. If you think the potential for migration to the shadows is greater, you want to lean, that your tax system is not as good, and you sort of want to do the work on the incentives. Okay, so it's absolutely at some level a second best argument, which presupposes that whatever you want to call it, your tax system is subject to some evasion or some distortion.
Sorry, just a small. So
Yeah.
if you were going to do if you could figure out how to do margin on all repo, collateral haircuts instead of this, you would be in favor of the first, or you'd still think you're thinking that's kind of a pipe dream?
No. First of all, I'm totally in favor. I don't view these as really substitute. In other words, I think you want to do the best you can with the regulation, and then respect that it's probably not perfect, and I think the regulation has a better chance of being effective if it's not fighting against an overwhelming economic incentive. So in other words, if the slope is, instead of being 70 basis points, if it's 20, I think the regulation has a chance. Look, the repo haircut stuff, I'm a big fan of, but I don't believe that that's the only way that guys can do short-term funding. There's a lot of short-term funding that's not just repo. I do think that sort of getting the incentives to not be too powerful for this stuff is helpful too.
Could you comment on why there's that big spread, given it's not really very long?
Why, in other words, the big spread between that? So, there is clearly a demand. I mean, it's just a supply and demand thing. There is a demand. I mean, and the reduced form of it is it's coming from things like money funds for very, very safe short-term stuff. And it has not been fully satisfied by, for example, the Treasury. Now, there are deeper, and this connects a little bit with Michael's thing, which is, I think a limitation of the way we're talking about it is we're treating all that demand as in some sense wholesome and legitimate money demand, right? It's just people who need this stuff for their good transactions to buy more motherhood and apple pie and all that kind of stuff. And you might want to ask a little bit, who's it coming from? So, you could tell a story, well, maybe a lot of it's coming from corporations that have amassed very big cash stockpiles. Some of that in turn may be because they've amassed big cash stockpiles abroad because they don't want to bring it home, and if that was the case, maybe you'd want to act a little on the policy would want to act not only on just accommodating this money demand, but also maybe reducing it by a set of other things. So that's a sort of pretty fair thing, because we're treating it as a black box and we don't really understand fully where it all comes from.
Maybe is there one more question? If not, I'm going to take the prerogative and ask mine, which is some people describe the Fed's balance sheet as a large carry trade, and it has large effects on fiscal policy through the way the money flows to the Treasury. Mm-hmm. So in advocating a permanently larger balance sheet, how concerned are you about the fiscal policy impact?
So again, to think about the fiscal stuff, the first thing you've got to do always is consolidate the two. So in other words, what this would amount to, right? So start in a world where there's just the Treasury. Now add the Fed with a big balance sheet where it's basically bought $4 trillion of long-term Treasury bonds and issued, $4 trillion of short. It's exactly the same as if the.
Except.
What's that?
I said except. In a frictionless world, that's true.
Right.
Under budgeting rules,
right.
The money that comes off of the Fed's balance sheet is
remitted.
available for Congress to spend for free.
But it's
so it feels like income in the political sense.
But I think it's the same income. In other words, let's compare two worlds. World one is the Treasury takes our recommendation. the Treasury issues way more bills, okay, and less bonds. What would happen? On average, they would have less interest expense because it's cheaper at the short end, but there'd be more variability of interest expense. If the Fed does this through their remittances, you'll get to the same place. In other words, the Fed will remit more on average because it's a profitable carry trade, but there'll be that variance, which is exactly, I think, even on an annual flow basis, because the Fed remits everything, I think it flows through. I think the political economy issue is that the part of it that comes from the Fed, if that goes negative in a year, like it gets noticed more than if there's just a deviation in Treasury's interest expense from some projection. That's the part about making the fiscal footprint smaller. Part of it is to protect the Fed by having less duration on the asset side. You get less chance of sort of remittances going negative. But I don't think it changes. I don't think it changes the consolidated picture. I could easily be wrong.
Great. Well, please join me in thanking Jeremy.
Thank you.